my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. 27 weeks ago here, and at every opportunity since, I said, and I quote, "The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal." And that is the well-highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. And that's the end of the quote. I know I sound utterly boring, but this point is important. I feel I must keep repeating it, such that in all things this year and going forward, all things should be seen in the shadow of this pattern. Okay, so from the May double top, prices headed lower until in mid-August they met the optimized neckline extension, currently at 926, of the February to October 2021 head and shoulders top. The market's decline was stopped dead in its tracks and reverted back upwards since, creating a dark blue mid-August to date bull channel, currently 1039 to 1102. The market also created a slightly wider pattern, a late July to late September reverse head and shoulders pattern, with a neckline currently at 1029 below the market and potential targets overhead of target X in the 1096 area and a secondary harder to reach, that was the primary target, and a secondary harder to reach target X1 up in the 1123 area. The market has overcome a variety of resistances on its way up from the break higher in mid-September, but what still lies ahead that may try and trap and cap this any rises. Well, immediately overhead we have the mauve declining medium moving average, currently at 1084, with not too far away the 50% Fibonacci line for the May to August move at 1098. Beyond that, we have the December 2020 low at 1143, as well as the declining long moving average, currently 1145, which may be a gateway to a variety of congestion areas between 1155 to 1161, then between 1178 to 1181, and at the May 2023 low at 1193. Any further move higher also helps fill in the changeover gap from July between 1056 to 1103, which has so far only been partially filled in. To be honest, it looks like light work topside until we reach the December 2020 low. Finally, there is a big picture item out there of the action since the double top in May to date as a possible descending scallop pattern. For this pattern to realistically work, prices would have to soon halt and then decide whether they wish to remain bullish or bearish before making their move. It is a bit early to say if this pattern will now fully deploy right now. Chicago soybean meal. The main pattern driver in this market has been the dark blue November 2023 to early May 2024 bearish shift pitchfork that you can see clearly on my daily chart. This pattern has been breached and arguably broken only as recently as last week, with prices having consecutive closes over the dark blue upper time, currently at 327.80. However, please note this break higher was not a spontaneous move, but rather the result of construction of bullish incentives, notably the mid-August to date bright red bull channel, currently at 324.5, the change of the purple highlighted trendline extension, that's currently at 323.30, from being actually a decent support, as we saw back in February this year, into more or less just a nuisance. And finally, the small late August to late September based ascending triangle that has an apex at the end of this week, and which is highlighted in bright green on my daily chart. I suspect this last one is perhaps the key from the initial drive higher, even if both the primary and secondary targets topside for this pattern have already been achieved. So what have we in a way topside that could deflect and even stop the recent rise? Well, we are right now within a congestion area between approximately the 61.8% absolute Fibonacci line at 336.30 up to the 50% Fibonacci line of the May to August move at 344 even, with the mauve declining medium moving average, currently 335.40, and the gold long moving average, currently 343.30, adding further resistances to these already here. However, there might just be enough ammunition here and below to push that a little bit higher, up to test the June and July base congestion between 344 even to 360.20, though I suspect the best overhead congestion is in a band between 363.70 to 368.80. This just leaves one outstanding item. I now only need to remind you once again of my words of 66 weeks ago, and ever since, so well over a year and a quarter ago, when I pointed out that the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since. Chicago soybean oil. The main recent actions in this market had been the construction of an early July to late August bear channel that almost from the start broke down through a key support that is still now acting today as a resistance, and that is the bright red highlighted neckline extension, currently at 45.04, to the October 2019 to February 2020 head and shoulders top. The start of this bear channel began with the market rejecting the overhead gold highlighted long moving average, currently at 45.13, and the end of it finished really in the middle of nowhere, between the then overhead November 2020 high at 39.04 and the December 2020 low below at 36.56. However, it was not a simple end, as the price over August to September took a second crack at heading lower, which failed, and we ended up with not only a dark blue mid-August to mid-September bullish Andrews pitchfork, the market currently hanging just like so much washing around the dark blue line of the middle time, currently at 44.28, but also with an August to date double bottom with a primary target X in the 46.36 area and a secondary harder to reach target X1 up in the 47.56 area. Not only that, but going back to the old bear channel pattern, we still have outstanding the potentials for a break upwards and out of this pattern. Thus, as I said 6 weeks ago, we have a primary target X2 up in the 48.23 area and a secondary harder to reach target X3 up in the 49.5 to 49.60 area. However, as I said 6 weeks ago, and I quote, "These two targets topside are not too far away from each other, and the move up would have to be quite dramatic to even have a look at them, so I'm cautious about them right now. However, it would not be too much to ask for a move up in between the green short medium moving average and the mauve medium moving average, relieving some bullish pressures built up from the bear channel." And that's the end of the quote. So as I said 4 weeks ago, and I quote, you can see from that, I'd have been happy for a move up to the green and mauve medium moving averages. The green short medium and the mauve medium moving average to relieve the bullish pressure. And that is what we have seen since. We now have overhead beyond the dark blue middle time, the bright red neckline extension as resistance along with the gold long moving average. It seems the more the market tries to move away from this bright red neckline, the closer it gets to it. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.